Good day to everyone. Welcome to Chartorium Trading Group. And today I want to give us some brief explanation of on what fair value gap (FVG) actually is. Fair value gap and imbalances. They are almost like the same thing, but they are just there's a slight difference between the fair value gap and the imbalance. And for people that are trained or people that are very private to me, probably the mentees and the student from the Chartorium Trading Group, analyzing this market won't be hard for you. You already know what you should do before you could be here. You understand? Starting from the higher time frame to this particular time frame I'm using. But the main aim of this video is to make it a public one, and that is why I'm not going to be going into details on how you can actually get to a certain point where you feel like you need to make use of your fair value gap. And for people we've been sharing signals for, you see some strategy, they'll be like, we made use of so fair value gap at so minute, and it's just going to pick your entry directly from there, and boom, without nothing, with no loss, no risk, you just keep going and going like that. So now I'm just going to be making use of maybe the 1 hour and the 15 minute, because that's the those are the fair value gap time frame I make use of the most for my entries if my strategy is based on the fair value gap type of strategy. So now we're going to be diving in on what is fair value gap. So now, fair value gap is an imbalance. Remember I said there is imbalance and there is fair value gap. And there's one thing to understand: if you are a fair value gap trader, you likely will be missing out on imbalances if the market used to make use of imbalance. And if you're an imbalance trader, you might actually be cutting out on some kind of loss or cutting in on losses if the market chooses to make use of the fair value gap. But that's not even the issue here. The main thing we're going to be focusing on is understanding exactly what it means to say something is a fair value gap, and what it actually entails, the criterias. So now I'm going to be defining what fair value gap is, and I'm going to say is an imbalance in price action. That is, in this market, in this chart, is an imbalance in this chart, is an imbalance in this chart created when a candle moves aggressively. What do they mean by a candle moving aggressively in one direction? Let's say we're on the 1 hour chart. You see, if you notice somewhere around there, let me get this rectangular shape here. If you notice somewhere around there, this market is giving spaces to both the green and the red candle. Everyone is communicating well. You understand me? But when it goes to somewhere around there, you see, you can only spot a whole green candle here. Green, 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 all through. Just a long green, long green, long green like that. So now, they said it's an imbalance in price action when action created when a candle moves aggressively in one direction. That is, when this green candle moved from this spot to this particular spot, it moved in a single direction. Are you getting me? Skipping over price levels. That is, it skipped to do things like this, things around there, something like this, where you can see a green and a red, corresponding with each other. They are not leaving each other. So now, it shows a lack of trade between buyers and sellers at that price range. That is, now you know that there's nothing like a red candle here, so there is no sell at all along this line here. It was only buyers. And now I said it shows a lack of trade between buyers and sellers at that price range, often forming a gap between candles. You see, from here to here, from here to here. So that is that on that. And these gaps are prime areas where price may return to rebalance. So I said FVGs are like imbalances. They are like imbalances. Just a little difference between what an FVG means and what an imbalance is. And I'm going to explain it into details. So now they said these gaps are prime areas. That is, this particular kind of place, the market These are prime areas where price, where this particular market, where these candles may return back to fill. And you remember I said fair value gap. So now, as a gap, you are supposed to fill. So this market too will do something like that and will come back to fill it. In most cases, actually, but there are criteria to it. And like I said, I'm not really going to be going deep into it because I want to make the video private. So if you really want to know deep things about this, you can enroll for our mentorship. It's actually free. The mentorship is free. The only thing you need to pay is seriousness and your attention, because if you are not serious, you get kicked out of the boot camp and the class. That's how we roll. It's just all about seriousness. So now, how does fair value gap forms? It occurs when a three candle pattern forms. This is one of the criteria. It occurs when a three candle pattern forms. Okay, let me check. You see somewhere like this, we're on the 1 hour time frame. Remember, this is okay. Let me just delete this. You see this side, this is a point, first candle, this is second candle. Are you getting me? And this is the third candle. Now you can already spot it here. You can have more than three candles, but at least three candles. There are criteria. Those are the criteria. So how does it form? It occurs when a three candle pattern forms. And this is 1 year, this is 2 year, this is 3 year. So now the first candle moves in one direction, which is here. It moved from here to here. That is the first candle. Then now the second candle makes a larger impulse move. This is the second candle from here to here. Are you getting? Then the third candle continue in same direction or consolidate. You see, the candle moved from here to here and it start consolidating. That is, you can see the red green at a particular range. They are not really surpassing each other at a particular point here. If I should place this to a lower time frame, you see like this took a long time because this is 1 hour chart. It took a long time for this ranging market around this side. Ranging market is when the market is at a particular point going in and out. And as you can see the market just going in and out of that place before breaking a little to this down. So now let's see how this is in the lower time frame. Let me come to the 15 minutes. Am I sure I'm seeing what I'm seeing? Okay, yeah. So now you see, this was the area we marked here to here. You see, the market was just going in and out. So fair value gaps forms mostly when there are three candles pattern. And now the gap is between the week low of the first candle. So let's go back to these are 1 hour chart, right? So now the gap is between the week low. What do you mean by week low? Week low of the first candle and the week high of the third candle in a bullish direction. And now in a bearish direction, the candle will be between the week high of the first candle and the week low of the third candle. But this is a bullish one. So now this is it. In a bullish direction, that is a market that is an uptrend, market that is going up, just like this one. So now what do we do here? The gap is between the week low of the first candle and the week high of the third candle. So now this is what I do here. Let me mark this out. I'm going to mark this out here like this. The gap started from this side here. You see, that is this place. There's a little space in between this place that was not filled. From that week to that place, this is an imbalance in the market. You see, there's an imbalance in the market, and the imbalance spread till around this side. Okay, it's still a little high. It spread till around this side. But now what I'm going to be doing is, now we've marked a particular point, which is this place. Then now I need to mark another zone again, which is this place. So now this is my fair value gap. The space between here to here, inside here is my fair value gap. So now if the market is going to, if you are a fair value gap kind of trader then you'll be waiting for the market on this particular line. But if you're an imbalance trader, are you getting me? You can just place it like 50%. Some trader makes of 50%, yeah. So maybe you are waiting to take a buy entry around this side. You just make it a 50% stuff. Maybe you can just take it at the middle here. Maybe you don't want to miss out on the trade. But for me, I actually make use of fair value gap instead of imbalance. So now, what are the time frames for fair value gap? The best time frame for fair value gap is the M15, which is the 15 minutes time frame, the H1, the H4, and daily time frame. But for me personally, I make use of the H1 and the 15 minutes, depending on the kind of strategy I want to use. So now, the lower time frame can show noise, and when you hear noise in trading, it means that there are manipulations, there's no stability. That is, you can't easily ascertain that this thing is true or it is not, because it's not going to be giving you a good vibe of what the market is actually saying. So the higher time frame are stronger and more reliable. And that's why I said I make use of the H1. For me, I make use of the H1. So now, when having a fair value gap, does the candle color matters? No, it does not matter. The candle color does not matter. As long as three candles are going to be forming the FVG, it doesn't matter at all. It does not matter. I'm coming. Let me find a proper example of a fair value gap that has like two colors. Let's see. Okay, this is one here. This green candle. This is an inverted hammer. Although I don't make use of all these names in my trading, the candles is really not an issue. We have a good strategy that does not respect what candle is saying. And remember, this synthetic indices is not the real world market. So now this is a green candle, this is a red candle, and this is another red candle. So let's mark this one out. And what I'm going to be doing here is I'm just going to do it this way. Okay, let me shift this. This is the one, the week low, then another one here. See that little space in between? It's just a little space in between. Just a little space. Although this is not a very solid one, but you can just see what I'm trying to explain. So the candle color does not matter. What matters is the structure and the wick placement. Just make sure that, okay, there is a spread in between those two. Then the location of high and lows that forms the imbalance. Are you getting? So now, how do you locate imbalances? And I've shown you. You look for three candles. You understand? You mark out the opening and the close of the first and the third candle. You do that for the bearish and the bullish. So how do you use it? You use fair value gap for entry, you use it for market direction, you use it for exit or your take profit. You understand me? And what does it mean? For entry, you wait for price to retrace into the FVG, into the fair value gap, and show signs of rejection. That is, maybe you make use of wick, you make use of candle type, you make use of anything. But for me, I don't make use of all those things. So I use this for entry mainly, and I use it for exit here. So and its direction, and that is used in confluence with market structure. I can easily tell that, okay, when the market gets to this particular place, I should take my profit here. So, and for my take profit, you mark out, like, I didn't analyze this market, and that's why I'm not really going into details of what it actually means to deal with this fair value gap in detail. But if you really want to know more, you can message our admin. The number is there on the links on the YouTube channel. So, and when do you use a fair value gap? In trending market or after a break of structure? Yeah, after a break of structure, that is when the market change direction, or in a trending market. So ideal after a large impulse move, or when price is in a discount or premium zone. And what do you mean by a discount zone? A discount zone is when it's in a buying zone, and a premium is when it's in a selling zone. And what do you mean by impulse? Impulse is just the aggressive movement, somewhere like here, from here rather to here. When the market is going in a direction from here to here, that is an impulsive movement. And what is a corrective movement? It's when the market now came back here from here and came back here just to fill this one. That is a corrective move. And what else? going into the features of fair value gap, going into the features, it acts like a magnet for price. That is, it will always attract the price back. You can see when this market move this way, it moved this way to this place, and you'll be like, oh, this market is selling, saying no, no, no. It came back to fill it completely. You see, it came back to fill this place. So this place acted as a magnet to drag whatever is happening here back to the top, just to fill this space. You can even see the little one here. It came back here to fill it completely. So, and fair value gap shows imbalances. It shows where the price are, are not corresponding with the sellers, where the buyers are not corresponding with the sellers. Then it works well in synthetic indices because this is an algorithm based behavioral what's it called, market. So now things to note is that all fair value gaps are imbalances, but not all imbalances are fair value gap. I said, like, if you are a fair value gap type of person, you'll be missing out on imbalances because sometimes the market will not actually touch, it will not actually fill the gap to that final line. It won't fill it to the final line. And now if you are a fair value gap type of trader, you are trying to cut your risk, you don't want to risk too much, or you don't want to risk, yeah, you don't want to risk too much, then you are going to be missing out on some certain trades. You understand? You're going to be missing out on certain trades. But if you're an imbalanced trader, as long as the market is going to respect the FVG, it's going to actually respect your imbalance. So now, all fair value gaps are imbalanced, but not all imbalances are fair value gaps. So now, and what are imbalances? Imbalances in general term is any price movement that shows inefficiency where buying and selling was one-sided. It's still the same definition. So it can form just one candle, a big impulse candle with no overlap on either side. It includes gap between candle bodies. Just like it's the same thing. You don't need to complicate yourself. It's the same thing. So imbalances in general market principle, and FVG is the technical tool used to trade. You understand? Imbalances is the general market principle and fair value gap. Remember what I said? Imbalances is the general market principle. Imbalance is the general market principle, and fair value gap is the technical tool used to trade it. So anything happening here now, all these gaps are imbalances. So fair value gap is what you use in trading what happened at this particular zone here. I would have shown some kind of analysis, but we always try to private our videos because we have a strict kind of rule. We only give them to those that are willing to get it. So now, what is an impulse move? An impulse move is a strong direction movement in price that breaks structure or pushes the market significantly in one direction. I said this is an impulse movement. Something that happened from here to here is an impulse movement. You see, just one direction. This is an impulse movement to one direction. But you can see this market actually still came back, consolidated, and came back to still make sure that this place is filled. You get? So an impulse move is just a market going in one direction. And what are the characteristics of impulse movement? You always have a long bodied candle. It will be breaking structure. So this was a structure here. This market came down, it broke it to the top. It broke it like that. It's an impulse move. Then it's fast and aggressive movement, very, very fast. Little to no pullback during the move here. There's no pullback, they are just going. So what else do we still need to know? Then what are the purpose? The signal dominant trend, that they want you to know if buyers are completely taking over or sellers are completely taking over. Then they represent strong buyers or seller intent. Exactly, you know that, okay, the buyers have more intent here than the sellers. Then they create market inefficiency that price may later correct. So if you know what you are doing, you know that, okay, since fair value gap acts as a magnet, it's actually still going to come back to fill that particular gap. Then the corrective move, the impulse move is the market going in one direction aggressively without giving space to maybe the seller. That is, if the market is aggressively buying, it won't give space to the red candles or the sellers. But if the market is moving aggressively in the selling mode too, it won't give space to the green candle. That is, you just be seeing the red candles. So now, what is a correctional move? A correctional move is a counter trend movement that corrects, that retraces a position of the previous impulse move. That is, it came back to few. It came back to few. And how can you actually do all these things? Once you analyze, there are some certain rules. We make use of trend line here, and the way we make use of trend line is actually somehow different. It's very, very unique. So when you are treating a fair value gap on those kind of structures, when you have your analysis, you're only concerned with what is in your trend line, not outside the trend line anymore. You only need what is in that trend line to trade. So you are not looking at, because it's not every time that the market will be filling gaps. No, it's not every gap that the market fills. And that's why the definition is it may come back to fill gap. It may. So it is not every time it fills the gap. So what are the purpose of fair value gap, impulse correction, and whatever? They allow the market to rebalance. Yeah, they bring this kind of perfect structures and grounded standard. You can see like, okay, this market is now settled. It's making sense. It's not just going in one direction. They provide opportunities for continuation trade. Yeah, they help trader identify discounted or premium entries. So discount is buy and premium is sell. Always remember that. So there are still some things that are available in our course book. We have that available for sale for 50 USD at this particular time. But maybe if you are a student of the academy, you have chances to discount. And the craziest thing about this thing is you have free signals for life when you register with us as a student. We drop signals, and our mentorship is lifetime mentorship. So if you really want to know a lot about all these things and how to make use of them, even related to strategy, everything related to trading is our course book. Everything about trading in general. So you can enroll as a student. You can decide to get a book. You can do whatever you want to do. So that is just all I have to say about fair value gap. That is all about fair value gap. And maybe we're supposed to be getting into balance and imbalance fair value gap, but the fair value gap and its impulse, the correction, the the corrective, the impulse, the fair value gap and imbalance. If you can actually understand all these things, imbalance, market artery structure somewhere from here to here, all these kind of structures, where the market moves in one direction, then you're really made. You're made. You can spot them everywhere on the charts, you see. They're just everywhere. They are everywhere. You keep spotting and spotting. They are just too much. There are too many, see. So that is that on fair value gap. Kindly like, subscribe, and share this video to people, to others. And if you like to know more about this, you can actually enroll for our mentorship. Our results are speaking for themselves. Don't need to brag, we don't need to show. So that's that on that, and have a good day, everyone. Remember the pair we made use of today is 25 1s. 25 1s. That's the name of this particular pair. So you guys should have a good day. Kindly subscribe, share, and relate it with more people out there. And if you want to gain access to our private video, remember you have to be a student. You have to be a student. We have private videos, we have private lecture videos, you understand, that can actually set your foot in this trading industry, that can make you, stand out and excel. So that's all I have to say, and have a beautiful day, my people. Bye.